Today we're going to pull back the curtain on the hidden rules of money. We're going to explore the invisible architecture that actually governs global finance, the deep underlying logic that decides what a currency is worth from one minute to the next. So let's dive in.
When you first look at the flashing numbers of global exchange rates, it just seems totally chaotic, random even. But what if I told you that behind all that noise, there's a powerful, almost perfect logic at work? So what is that logic? And more importantly, what happens when it breaks?
Okay, so our journey starts with a really simple but powerful idea. It's a rule that should always be true, but, sometimes it just isn't. It's something called the law of one price.
The core idea is super simple. It shouldn't matter how you buy a dollar. Whether you use euros to buy it or Swiss francs or any other currency, the price should be exactly the same everywhere. This principle is called cross-parity. But is the market really that perfect? Let's take a look at some real data.
So right here we can see a tiny crack in the system. If you look at the exchange rates in Paris, a US dollar should cost you 0.9546 Swiss francs. But if you actually go to the market in Zurich, it's a little bit cheaper at 0.9540. It's a tiny difference for sure, but in the world of finance, that's a glitch in the matrix.
I mean, we're talking about 0.06 of a cent. It sounds like absolutely nothing, right? But in a world where trillions of dollars are flying around every single day, that's not just a rounding error. That's an opportunity. It's a big, flashing signal that something is out of balance. And guess what? The market has this built-in, automatic way to fix it.
And that fix has a name. It's called arbitrage. You can think of it as the engine that enforces that law of one price. And the way it works is by chasing after those tiny little glitches to make a completely risk-free profit.
So how does this actually play out? Let's walk through the trade step by step. You start with just one Swiss franc. First, you use it to buy dollars in Zurich, because remember, they're cheap there. Then, you immediately take those dollars and sell them for euros in Paris. And finally, you convert those euros right back into Swiss francs. It's this perfect little loop. So, what do you get from this lightning-fast trade?
Well, you end up with 1.0004 Swiss francs. It's a tiny, tiny profit, but it is guaranteed. It's risk-free. You started with 1 franc, and by doing nothing more than jumping on that price difference, you ended up with more. Now, imagine doing that same trade, not with 1 franc, but with 1 billion.
And this is where the real magic happens. This isn't just about making money. The very act of doing this trade fixes the problem. All that buying of dollars in Zurich starts to push the price up there, and all the selling in Paris pushes the price down there. This arbitrage trade keeps happening until, poof, the glitch is gone and the price is the same everywhere again. It's a perfectly self-correcting system.
Okay, so arbitrage is what keeps prices consistent right here, in the present. But what about the future? Is there a rule that connects today's price to what it might be, say, a year from now? You bet there is. It's got a fancy name, Uncovered Interest Rate Parity, or just UIP. Now, I know that sounds super complicated, but the core idea is actually pretty simple. It basically says that if you can earn a higher interest rate in one currency, the market expects that currency to lose a little bit of value over time just to even things out. Your extra interest earnings should get canceled out by the currency getting a little weaker.
Let's make this real with an example from our source material. On this particular day, you could get a 2.5% return for a one-year investment in the US, but only 1.84% over in the UK. So the obvious question is, why would anyone ever invest in the UK? Well, UIP gives us the answer.
Here's the logic. The market as a whole expects the US dollar, with its higher interest rate, to lose a little value against the British pound over the next year. So the thinking is that the lower interest you earn in the UK will be balanced out by the pound itself becoming stronger. In theory, it all washes out, and your overall return is about the same. So you see, UIP isn't just some dusty old theory in a textbook. It's actually a tool. It works kind of like a financial crystal ball, letting us calculate the market's collective best guess about where exchange rates are probably headed. And check this out. Here's what that crystal ball was predicting. If today a dollar gets you 0.86 pounds, UGP predicts that in 1 year it'll be worth a little bit less, 0.8544 pounds. And then over 10 years, that effect really starts to add up, with the model predicting the dollar could fall to just under 0.80 pounds. And this right here is the logical bridge between the present and the future. An investor is, in theory, kind of indifferent between the two.
Why? Because the lower interest they get from the UK is expected to be made up for by the pound itself becoming more valuable. It's all about creating balance.
So let's zoom out and put these two big ideas together. What we've really uncovered are two powerful hidden rules that are constantly running in the background of the entire global financial system.
So on the one hand, you have arbitrage. It's like the high-speed enforcer, zapping away any price differences in the present moment, making sure a dollar is a dollar, everywhere. And on the other hand, you've got interest rate parity. That's the forward-looking rule, the one that creates a predictable path for currencies over time.
So why does any of this matter? Well, because without these rules, global finance would be absolute chaos. International trade, investing, none of it would be possible. This invisible engine is what provides the stability and predictability that our entire modern economy is built on.
Now, these rules are incredibly powerful, but they are based on theories of how a rational market should work. And that leaves us with one final, really crucial question. In times of crisis, of panic, of extreme uncertainty, what happens when that engine breaks down? What happens when the hidden rules just don't apply anymore? That's something to think about. Thanks for tuning in.